After the strongest back-to-back market years since the late 1990s, markets are at a critical crossroads. The range of potential outcomes is extraordinarily large. A productivity boom, a great inflation, a melt up, a meltdown. I've heard investors, analysts, and strategists make the case for all of those and just about everything in between. To cut through the fog, I've invited a brand new MoneyShow MoneyMasters Podcast guest to join us. He's Eric Wallerstein, Chief Market Strategist at Yardeni Research, and you are not going to want to miss what he has to say. Eric, welcome to the show.
Thanks, Mike.
Yeah, look, I love getting new guests with new perspectives on the show. But since you are new, why don't you start a little bit by sharing your background and what it is you do at Yardeni Research with our viewers here?
Sure. So I started out at the New York Fed on the repo desk. I was there in 2019 when we had that money market rate freak out, and then as COVID started as well. So it was a very interesting time. I was trading in the repo and reverse repo operations. So a lot to learn. And then I joined Yardeni early last year from the Wall Street Journal, where I was covering asset allocation, FX, treasuries, the banking system when SVB kind of blew up. So a range of things. But yeah, I'm kind of a jack of all trades here, just as Ed is, covering the waterfront of macro, both here and abroad. And it's an exciting time in markets, as it always is, but a lot to go over.
Yeah, absolutely. Why don't we start with sort of the big picture economic view here? I mean, where are your thoughts? Where are we with inflation and kind of what the Fed has done in the last several months, and maybe what your outlook is for what they're going to do over the first few quarters of 25?
Sure. Yeah, I think the big issue or sticking point is sticky inflation, especially on the core services side. So we had PPI this morning, and we'll have CPI tomorrow for December. But I think a lot of people mistook over the summer. We had this slowdown in hiring. We kind of had a weak jobs report, payrolls revisions. We had a slowdown in inflation. I think people mistook what was kind of a blip for this broad slowdown from long and variable lags of monetary policy. In reality, what exactly are long and variable lags? They're kind of just this mirage that people use to explain crises that happen after the Fed tightens. In our opinion, the crisis was SVB and the regional banking panic, but the Fed and the Treasury stepped in, they eased conditions. So that blip kind of set the Fed on this easing path, and 100 basis points of easing over just a few months is really nothing to scoff at. But then the economy rebounded, both in terms of it's just a strong economy with a pretty strong labor market, but also the Fed was easing conditions, and they basically told markets and business owners that conditions will be easier. So we have inflation kind of ramping back up or sticking too high above 2%. And now we have businesses saying we're going to hire more, we're going to raise wages, we have potential tariffs, which could easily raise prices. So there's all these things that are happening, and we're stuck with 100 basis points lower on the Fed funds rate. So I think, heading into this year, we might see a lot of reactions to the Trump administration, and that could be both good and bad. I think we're going to see more hiring, more investment, more CapEx, both from small and large businesses. They're more certain. They're expecting a lower corporate tax rate. They're expecting deregulation. But I also think there could be some, inventory investment that's not necessarily productive, trying to front run tariffs. I think there could be a little more hesitancy, if you're an exporter. But we'll see. We'll see how these first 100 days go. And it's just, another uncertain year after uncertain year, I suppose.
Yeah, I hear you. It's interesting. One of the pieces you had recently, you kicked off the year with kind of this analysis of what could go right in 2025 and what could go wrong. I know there's a lot of material in there, but maybe just a few of those points on either side. What do you think is probably one of the best things that could go right, one or two things, and what are, on the flip side, things that could potentially go wrong?
Yeah, I think one of the things that people are kind of missing, especially since we're talking about bonds and the Fed pretty much all day, and there's a lot of Trump noise around what potential policies might be, is that earnings growth is really the engine that drives equity markets higher. It's what drives forward earnings, and then therefore more high, ultimately the entire economy. So earnings growth looks good. I mean, even just in Q1, analysts expect 8.2% year-over-year earnings growth. We're looking at more like 10%. Real GDP looks good, 2 to 3.5%. Through the remainder of the year, we think is quite possible. And productivity growth, I think, is another big thing that a lot of people are missing. So we had 2%. That's historically average. It's kind of what we expect. And you can think of productivity growth as all real GDP. It's like the best form of economic growth. It helps expand corporate profit margins. It leads to higher real wages for workers. It's amazing, and it keeps inflation down, most importantly. So you can actually get a better real wage without putting upward pressure on overall inflation. So it's a great thing, and we think it could go higher. We're expecting 3.5%, 4% productivity growth over the next few years. And by the end of the decade, it sounds very large, especially compared to some of the post-Great Financial Crisis malaise. We bottomed at like 0.5% of productivity growth for the 5-year rolling period from 2010 to 2015. So like you're getting no economic growth, right? No one's being productive. Some of that might have to do with ZIRP and zero interest rate policy. There's a lot of zombie companies, but there was a lot of moving parts there. We think it bottomed there, and it's been on a steady uptrend since. So 2% right now, sure, but especially if you get more deregulation, corporate tax cuts, also AI, automation, robotics, whatever, I think you're going to get a lot of real GDP growth from productivity, even as labor force growth slows. So I think there's a lot of positives for the economy as well as for corporate earnings that it kind of gets lost when you get stuck talking about monetary policy and bonds all day.
Right. I'm glad you brought that up because, I mean, obviously, especially in the last couple of weeks, seems like everybody and their sister is worried about rising rates. You actually tweeted not too long ago about buying bonds, and I'm kind of curious, why aren't you scared about this big bad 5% number that everybody seems to be worried about when it comes to the 10-year?
Yeah, those are definitely PA trades and not financial advice. But yeah, I think bonds have largely tracked the strength of the economy, and that's why yields were rising. I think a positive upward sloping yield curve makes sense, like 30, 40, 50 bips. That's also what we saw around 1995 and in the late 90s, which is probably the most comparable period to today, like a soft landing. We had a few rate cuts, and then they kind of stuck with higher for longer. That said, there's maybe an overreaction. I don't think there's a ton of news on the fiscal front. I don't think Trump 2.0 is a huge departure from what Biden was doing in terms of the fiscal deficit. I think we could either stay here, we could shrink the deficit marginally. I don't think a lower corporate tax rate is like the end of the world per se. And I think the incoming administration is actually attentive to the deficit, whereas the prior one, or the current one, I suppose, is a little less so. They kind of just let it run and weren't too worried about it. I think they did a lot in terms of debt management to possibly even stimulate the economy further, focusing on short-term bills rather than actually issuing duration treasuries to the market. So there's that component. I also think China is the second biggest economy in the world, and it's quite literally in a recession. It's been a huge downward influence on inflation globally. Like goods inflation in the US has been kaput for 1.5 years. It's been deflating. So even as consumer demand, possibly, producer demand comes back for goods, durables, and non-durables, I think we have this huge external pressure coming from China, and it's really crushing Europe. Like Germany's export sector is crushed. They can't, industrial production there is falling precipitously to record lows. And so you have, a US economy that's doing quite well, but the rest of the world is doing pretty bad, pretty poorly. So you see 5% yields in the US. I think inflows are going to be pretty strong. I think the strong dollar reflects that. And sure, there's buying of mortgage-backed securities. People are buying corporate debt. People are buying US equities. But by and large, the US is such an attractive investment case right now, relative to history, relative to the rest of the world, that I think, yields have plenty of reason to fall. And I don't think they'll fall that far. 4.25% might be a bottom. 4.75% might be a top for the 10-year. It might bounce around in that range. But 5% on the 30-year, 4.75% in the 10-year, I'm not sure that really lines up with where economic fundamentals are.
Yeah, got it. You and Ed do fantastic work in the Yardeni Quick Takes newsletter. So if anybody's watching this, you're doing yourself a favor if you subscribe. And one of the things in there, you had a great update. You said stock market valuation and beauty have a lot in common. They're both in the eyes of the beholder. Can you expand a little bit on that point and kind of what your message was there?
Yeah, so a lot of people are concerned with valuations. They're lofty relative to history. Also with higher yields, it's kind of coming more into focus. I think the difference between today and previous periods where you're comparing either valuation or market concentration to, is the type of companies that are highly valued. The S&P, when you cut out the Mag 7, so the S&P 493, it's trading at like 18 times forward earnings. It's not low, but it's certainly not anything exuberant. And, Apple, Meta, Nvidia, Microsoft, these are the companies that are trading 28, 29, 30 times forward earnings. But they're growing companies, right? They have the earnings growth to back that up. And if you think about it, the index used to be, comprised of companies that were more mature, that had slimmer margins. And, as you grow out of being at a lower valuation, today, the highest quality stocks, the biggest stocks are also growing rapidly. And so far, there's nothing to say that growth is going to slow. I mean, NVIDIA's profit margins are over 50%. That's crazy for, like a $1 trillion plus company in terms of market cap. So sure, valuations are tricky, but I think, there's a number of people saying, 3-4% annualized returns on the S&P 500. We're expecting double-digit earnings growth. Not even talking about total return and dividends. We should achieve at least historically normal returns for the large cap index. So I think things look good. It makes sense that these companies are trading at high value, lofty relative to what their companies can actually do.
Got it. You mentioned NVIDIA. That's an obvious name that I looked at actually earlier today. I looked at the top performing companies and stocks in the S&P 500 last year. NVIDIA was there, Palantir, a couple other tech names, and ironically enough, United Airlines up there as well. When you look forward to either individual stocks or sectors, what are some of the again, groups, and if you're comfortable talking about a couple names, things that you and the team there are particularly optimistic about for the new year?
Yeah, so we stay away from single stocks, but we do have sector preferences. For a little while, we've been basically long the names you'd be in an economic expansion. So financials, industrials, consumer discretionary, infotech especially, which includes for us comm services. But I think financials are a really good and interesting play. Back in August, we suggested that, there was a small bank catch-up trade, at least as the Fed was cutting. And a lot of people got really excited about the regional bank ETFs and some of those kind of downbeaten names, which especially took a hit after SVB and that regional banking crisis. But I think there's a lot of runway for big banks. I think consumer credit quality is perfectly fine. I think it looks very good. Debt levels are low. Consumer incomes are rising. I think savings are fine. And there are a little bit upticks in delinquencies. If you listen to bank earnings calls and card earnings calls, it seems to be concentrated in just like people who over-indebted themselves during the pandemic. It doesn't seem to be a broader issue. So I think consumer balance sheets look healthy. Banks are starting to lend again. If you look at the Senior Financial Opinion Survey, Senior Financial Officers Opinion Survey, the SFOOS, banks are actually starting to loosen credit conditions and lend again in C&I loans, commercial real estate, et cetera. So I think there's this huge opportunity for banks to continue earning. We also have the M&A front. The FTC in the Biden administration was incredibly strict on M&A, and we had the rapid rise in rates, right? So M&A should come back. Trading revenues have been pretty good. And then there's this huge deregulatory regime. Michael Barr, the Fed Vice Chair for Supervision, is leaving his post early. President Trump will likely replace him with either Michelle Bowman or Governor Waller, and both those are better for Basel III Endgame. It's not going to be very strict. I think, if anything, the Wall Street and the bank lobbying groups will have much more power to basically reverse this trend of increasing regulation, increasingly a constricting, DC policy reign over banking. And I think it just opens a lot of pathways for big banks. So I really like financials. And then the rest of those groups, I think, have been doing well and should continue to do well.
The financials, industrials, and tech, probably the best places to be, in your opinion? Yeah,
definitely.
Great. Now, one of the reasons we're talking is because we're privileged to have you joining us for the MoneyShow Masters Symposium in Dallas and coming up in April. You have a very interesting topic, and I kind of alluded to it in the intro. It's what's next for the economy and markets, productivity boom, great inflation, or melt up. Can you just briefly summarize kind of, what types of things you might be talking about and what attendees are going to get out of that?
Yeah, so I think these three possible scenarios are a great framework for looking at 2025 and even beyond, especially with this new administration. we've been really banging the drums on the roaring 2020s. We think productivity growth is really going to fuel. Also pretty good chances of a market melt up, which 100 basis points of Fed cuts, stickier inflation, higher bond yields. These are all things where stocks rise in the short term, but to the intermediate to long term, there are a lot of issues in terms of the deficit, in terms of Fed credibility, kind of longer term. Okay, like what are we betting on here when we're buying US assets for domestic and foreign investors alike? And then there's this other bucket of just everything that could go wrong. I think especially on the geopolitical front, there's some uncertainty and there's some more certainty, right? If the wars in the Middle East between Russia and Ukraine end, that's a huge plus for global markets and global economies, especially for Europe, which is struggling with energy costs. But, trade wars, they're question marks. Even if they do ultimately work and shore up domestic manufacturing, there could be a lot of volatility in the immediate term. So that's difficult for investors and owners to navigate. And we'll see what happens with the deficit. I think this incoming administration has a plan to tackle it, but it's not going anywhere good. You know what I mean? Yeah. So I think there's plenty to talk about. There's a lot of cross currents, both positive and negative, and it's an exciting time, really.
Well, listen, Eric, I really do appreciate you taking some time out to chat here. Viewers, if you're watching this and you want to learn more from Eric, he is going to be speaking at that Master Symposium in Dallas, which is in early April. You can find more details on the event and actually register to attend if you like in the description below. And again, if you like this video and these things we do for the podcast, don't forget to like and subscribe. Eric, thank you so much. And I'll be seeing you in Dallas in a couple of months.
Thanks, Mike. Looking forward to it.
Take care.